The United States government is now spending more money on interest payments to bondholders than it spends on the entire national defense budget combined. This single statistic should send a shiver down the spine of every American taxpayer because it marks a mathematical point of no return. We have officially breached the $38.5 trillion mark on the national debt clock, and the acceleration is terrifying. We are no longer borrowing money to build infrastructure or fund education or even to provide a safety net for the vulnerable. We are now borrowing money simply to pay the interest on the money that we already borrowed 20 or 30 years ago. If you want to understand how this specific mathematical trap will devalue your savings and destroy your purchasing power, you need to subscribe right now. I am analyzing the latest Treasury Department data to show you the exact moment our fiscal policy went from sustainable to insolvent. Hit that notification bell so you're alerted immediately when the next parts of this deep dive are released, because this affects your wallet directly. Please leave a comment below telling me if you believe the government has any plan to pay this back or if they will just inflate it away. I want to gauge the sentiment of the American people on whether fiscal responsibility is dead or if there is still hope for correction. The number 38.56 trillion is so massive that the human brain cannot actually comprehend the scale of the obligation. If you stacked 38 trillion $1 bills on top of each other, they would reach the moon, and back not once, but multiple times. But the most alarming part of this crisis is not the total number, it is the unprecedented speed at which we are adding to it. We are currently adding $1 trillion of new debt to the national balance sheet every single 100 days on average. That means the United States government is effectively borrowing $10 billion every single day just to keep the federal government running. This is not a political talking point, because the mathematics of compound interest do not care who is sitting in the Oval Office. Both parties have contributed to this spending addiction over the last 4 decades, and now the bill is finally coming due. When interest rates were near 0% for over a decade, we could afford to carry a massive debt load without feeling the pain. Free money allowed Washington to borrow trillions without worrying about the cost of servicing that debt in the annual budget. But those days are officially over, and the bond market has woken up to the reality of persistent inflation and sovereign risk. The average interest rate on our national debt has risen significantly as the Federal Reserve fought to bring down the inflation rate. This means that every time a low-interest bond matures, the Treasury has to refinance it at a much higher market rate. It is exactly like having a massive mortgage with a teaser rate that just reset to a level you cannot actually afford to pay. You did not buy a bigger house or spend more money, but your monthly payment just doubled and you're drowning in interest. The Congressional Budget Office has confirmed that interest payments on the debt have now exceeded $1 trillion annually. Think about the implications of spending more to pay wealthy asset holders than we spend to equip and pay our military forces. This creates a massive strategic vulnerability that our geopolitical adversaries are watching very closely as they manage their own reserves. If we are forced to choose between paying interest to bondholders and funding our national defense, we are in a position of weakness. But the problem is actually much deeper than just the defense budget comparison that makes the nightly news headlines. Interest payments have now become the second largest line item in the entire federal budget, trailing only Social Security. Within a few short years, interest payments will consume more tax revenue than Medicare and Medicaid combined at the current pace. This creates a scenario known as fiscal dominance, where the Federal Reserve loses the ability to control monetary policy effectively. They cannot raise interest rates to fight inflation, because it would bankrupt the U.S. government through higher debt service costs. But if they lower interest rates to save the government, they risk reigniting inflation and destroying the value of the U.S. dollar. This is the debt trap that I have been warning my clients about for years, and we are now standing directly inside of it. There is no easy mathematical way out of this trap, because the numbers simply do not work for a soft landing anymore. To pay down this debt, we would need to run massive budget surpluses for decades, which is politically impossible in this environment. It would require tax hikes on the middle class that would crush the economy and cuts to entitlements that would cause social unrest. No politician who wants to remain in power will ever vote for the level of austerity required to actually balance this ledger. So the only option left for the government is to continue borrowing and printing money until the currency loses its value. This is why you are seeing the price of scarce assets like gold and real estate hitting all-time highs despite high interest rates. The market is sniffing out the insolvency of the sovereign balance sheet and moving capital to assets that cannot be printed by a central bank. But for the average American family who earns their wages in dollars, this is a silent tax that steals your wealth every day. Every $1 trillion that is added to the debt effectively dilutes the purchasing power of the dollars in your checking account. It is the primary reason why your grocery bill is up 30% and why housing affordability is at record lows. Inflation is not just a temporary supply chain issue, it is a monetary phenomenon caused by excessive government spending and debt monetization. And with a deficit that is running at nearly $2 trillion a year during a time of peace, we are in uncharted waters. Historically, governments only run deficits of this magnitude during major wars or deep economic depressions to stimulate demand. But we are running wartime deficits while the unemployment rate is relatively low and the stock market is near record highs. This is unprecedented in economic history, and it signals that the financial system is broken at a fundamental structural level. The Treasury Department is now issuing so much debt that they are occasionally having trouble finding buyers for all of it. Auctions for U.S. Treasuries have seen pockets of weak demand, which forces yields higher to attract the necessary capital. This pushes up mortgage rates and auto loan rates for you because the entire credit market is pegged to the Treasury yield. So when the government borrows $10 billion a day, it crowds out the private sector and makes it harder for you to borrow. You are effectively competing with the U.S. government for the limited pool of savings that is available in the global market. And the government does not care what the interest rate is because they have the power of taxation and the printing press. You do not have a money printer, so you are the one who gets squeezed out of the housing market by high rates. This dynamic is slowly crushing the small business sector, which relies on affordable credit to expand operations and hire workers. It is also putting a ceiling on the housing market by keeping mortgage rates artificially high, even as the economy cools down. But the scariest part of the $38.5 trillion number is that it does not include the unfunded liabilities. The $38 trillion is just the on-book debt that is officially recognized and reported by the Treasury Department. It does not include the future promises that the government has made for Social Security and Medicare payments to retirees. When you add up the present value of those unfunded obligations, the true debt number is likely over $100 trillion. We have promised benefits to the baby boomer generation that we simply do not have the money set aside to pay for. As more boomers retire every single day, the strain on the system intensifies, and the cash flow turns significantly negative. We are entering a demographic crisis at the exact same moment that we are entering a sovereign debt crisis. This is the perfect storm that fiscal conservatives have been fearing for decades, and it is finally making landfall right now. The trust funds for Social Security are just accounting fictions filled with non-marketable Treasury IOUs, not actual cash. There is no vault of money in Washington, D.C. waiting to pay your benefits, only promises from the government to tax future workers. So when the system runs a deficit, the Treasury has to borrow more money from the public to pay the current benefits. This creates a doom loop where debt begets more debt, and the interest payments spiral out of control exponentially. We are approaching what economists call a Minsky moment, where the debt levels become so high that they trigger a collapse. This is not fear-mongering, it is just looking at the balance sheet of the United States of America with a calculator. If you ran your household finances like the federal government, you would be in prison for fraud or bankruptcy court by now. You cannot spend 50% more than you earn every single year and expect to remain solvent for the long term. Eventually, the credit card company cuts you off, and the creditors come to take your assets to settle the balance. For a country, the creditor is the bond market, and the repossession is a currency crisis where the money collapses. We are seeing the early signs of this with the subtle de-dollarization trend that is happening in global trade. Central banks around the world are buying gold at a record pace because they do not trust the U.S. fiscal trajectory. They see the $38 trillion debt in the political gridlock, and they are quietly diversifying away from the dollar. This reduces the structural demand for our debt, which forces interest rates even higher and exacerbates the fiscal problem. It is a vicious cycle that feeds on itself and accelerates until something in the financial plumbing finally breaks. We saw a preview of this in the UK bond market recently, when their yields spiked due to unfunded spending plans. The central bank had to step in and print billions of pounds instantly to save the pension funds from total insolvency. That is exactly what will eventually happen here in the United States when the bond market finally revolts against the spending. The Federal Reserve will be forced to implement yield curve control to cap interest rates artificially to save the Treasury. This means they will print unlimited amounts of money to buy the bonds that the private sector refuses to buy at low rates. It is the endgame of every fiat currency system in history, and we are walking blindly towards it with our eyes closed. The $38.5 trillion milestone is not just a number on a clock, it is a flashing red warning siren. It is telling us that the current fiscal path is mathematically unsustainable, and that a major correction is inevitable. Most Americans are completely unaware of this danger because the mainstream media rarely discusses the nuance of the debt. They focus on the daily political drama, while the financial foundation of the country rots away beneath our feet. But you cannot ignore the math forever, because math always wins in the end, regardless of the political narrative. The government is betting that they can inflate away the debt by keeping interest rates below the real inflation rate. This is called financial repression, and it is a deliberate policy to transfer wealth from savers to debtors over time. If you keep your money in cash or low-yielding bonds, you're the victim of this wealth transfer policy. You're effectively paying off the national debt through the erosion of your own purchasing power every single year. This is why understanding the $38 trillion number is the first step to securing your own financial freedom. It wakes you up to the reality that the system is rigged against the prudent saver in favor of the reckless spender. The rules of money have changed, and you need to adapt your strategy to the new rules of the debt trap immediately. We are watching a slow-motion train wreck that has been decades in the making, and the impact is now imminent. The next few years will define the economic future of this country for the next generation of American citizens. Will we face the hard choices and restore fiscal sanity, or will we try to print our way into hyperinflation? The answer to that question lies in the bond market and the behavior of the $38 trillion debt pile. This brings us directly to the specific mechanism of the crash. Because the debt pile is not just sitting there harmlessly. The $38.5 trillion number represents a massive claim on the future productivity of every single American worker. But the immediate danger facing the economy right now in 2026 is what financiers call the maturity wall. Most people assume that the national debt is a long-term 30-year mortgage that we pay off slowly over decades. The reality is that a terrifying percentage of our national debt is actually short-term debt that matures in less than 1 year. In 2026 alone, the United States Treasury has to refinance approximately $10 trillion of existing debt. This means the government must go to the open market and find buyers for $10 trillion of bonds just to stay afloat. They are not paying off this debt, they're simply rolling it over into new bonds at today's much higher interest rates. This creates a massive liquidity black hole that sucks all the available capital out of the global financial system. Every dollar that an investor uses to buy a U.S. Treasury bond is a dollar that cannot be used to buy anything else. It is a dollar that cannot be used to fund a small business loan or a mortgage for a new home buyer. It is a dollar that cannot be invested in the stock market or used to build a new factory to create jobs. This is the textbook definition of crowding out. And we are seeing it happen in real time on a massive scale. The government is effectively sucking the oxygen out of the room, leaving the private sector to suffocate from a lack of credit. But the government has a unique advantage that you and I simply do not have in this competitive environment. They do not care what the price of money is because they are not spending their own earned money to pay the interest. They can offer whatever yield is necessary to attract buyers, even if it destroys the rest of the productive economy. If the Treasury has to pay 6 or 7% to sell bonds, they will do it without hesitation or bankruptcy risk. But a small business operating on thin margins cannot afford to pay 12% for a working capital loan. So the government gets funded while the productive part of the economy gets starved of the capital it needs to grow. This is why you're seeing a massive divergence between the booming government sector and the struggling private sector. But the maturity wall is not just a problem for the federal government, it is a crisis for corporate America too. During the zero interest rate era, thousands of companies borrowed massive amounts of money to buy back their own stock. They loaded up their balance sheets with cheap debt, assuming that interest rates would stay low forever. Now those corporate bonds are maturing in 2026, and these companies have to refinance them at much higher rates. We are seeing zombie companies that were barely profitable at 3% interest suddenly facing 7% interest payments. The math simply does not work for them anymore, and they are facing a wave of defaults and Chapter 11 bankruptcies. This is the specific mechanism that triggers a recession, even if the consumer is still trying to spend money. When companies cannot refinance their debt, they have to cut costs immediately to survive the cash flow crunch. That means mass layoffs and a freeze on hiring, which eventually trickles down to the consumer economy. We are already seeing this in the commercial real estate sector, which is facing its own massive refinancing cliff. There is nearly $1 trillion of commercial real estate debt maturing this year, and the banks are panicking. The office towers backing these loans are worth significantly less than they were when the loans were originated. If the banks force the landlords to pay off the loans, the landlords will simply hand over the keys and walk away. This would leave the regional banking system holding hundreds of billions of dollars in distressed assets. This brings us to the most dangerous feedback loop in the entire financial system, which is the banking sector itself. Your local bank is sitting on massive unrealized losses on their bond portfolios because of the high interest rates. When rates go up, the value of existing bonds goes down and banks hold trillions of dollars of these bonds. As long as they do not have to sell them, they can pretend that the losses do not exist on their balance sheet. But if depositors get scared and start pulling their money out, the banks are forced to sell these bonds at a loss. This is exactly what happened to Silicon Valley Bank, and it is a risk that is still lurking in the system today. The relentless issuance of new government debt keeps pressure on interest rates, preventing them from falling significantly. This means the banks remain underwater on their portfolios for much longer than anyone anticipated. It creates a fragile system where a single spark can trigger a run on the banks in a full-blown financial crisis. But there is an even bigger player in this game that drives the entire machine, and that is the Federal Reserve. The Fed is currently caught in a mathematical trap of its own making known as fiscal dominance. Normally, the central bank operates independently of the government to keep inflation low and employment high. But when the government debt becomes this large, the central bank loses its independence completely. The Fed cannot allow the U.S. Treasury to fail at a bond auction because it would trigger a global collapse. So if the private market refuses to buy the $10 trillion of refinancing debt, the Fed must step in. They will be forced to print money to buy the bonds themselves, effectively monetizing the debt directly. This is the pivot that Wall Street is betting on, but it comes with a terrible price for the average American. If the Fed prints money to buy the debt, it unleashes a new wave of inflation that could be far worse. We are talking about structural inflation that sticks around for a decade, not just a temporary spike in prices. This is why the $38.5 trillion debt is not just a number on a clock for economists to debate. It is a gun pointed at the head of the US dollar and the purchasing power of your savings account. The government has two choices, and both of them are painful for the citizenry of this country. Choice number one is to default on the debt, which would cause a deflationary depression and wipe out the banking system. Choice number two is to inflate away the debt, which destroys the middle class and wipes out the value of wages. History tells us that governments almost always choose option number 2 because it is politically easier. They would rather print money and blame greedy corporations for inflation than admit they are bankrupt. This is financial repression in action. And it is a deliberate transfer of wealth from you to the state. They are stealing the value of your labor to pay for the debts of the past without ever passing a tax increase. You feel it every time you go to the grocery store and see that the price of eggs or meat has doubled. You feel it when you look at house prices and realize you need a significantly higher income just to afford a starter home. This is not an accident. It is the direct result of the fiscal dominance that we are living through right now. The scary part is that most investment advisors are still giving advice based on the old rules of money. They are telling you to buy a mix of stocks and bonds and hold them for the long term. But in a world of fiscal dominance, bonds are no longer the safe haven asset that they used to be. They are certificates of confiscation that guarantee you will lose purchasing power after inflation and taxes. If the inflation rate is 5% and your bond pays 4%, you are losing real money every single year. And yet trillions of dollars of retirement savings are sitting in these assets waiting to be devalued. The mechanism of the crash is not going to be a sudden explosion like we saw in 2008. It is going to be a slow bleed, where the standard of living for the middle class grinds lower and lower. It is a world where you work harder every year just to stay in the same place financially. The $10 trillion maturity wall in 2026 is the catalyst that accelerates this process significantly. It forces the system to confront the reality that there is not enough real capital to fund the government's addiction. So the government will print the difference, and you will pay the price in the form of a devalued currency. This is the harsh reality of the math, and it does not care about your hopes or your dreams. But knowing this mechanism gives you a massive advantage over the 99% who are asleep. You can see the train coming down the tracks, and you have the opportunity to step off before it hits. You do not have to be a victim of financial repression if you understand how to position your assets properly. There are specific asset classes that historically perform well during periods of high debt and high inflation. There are ways to opt out of the system that is trying to steal your wealth through currency debasement. Most people will sit and watch their savings evaporate because they are waiting for the government to fix it. But the government cannot fix it because the government is the cause of the problem. The solution has to come from you taking personal responsibility for your own financial sovereignty immediately. We need to pivot from analyzing the problem to executing a concrete solution and an actionable plan. You need to know the specific assets that you need to own to hedge against the debasement of the dollar. You need to know how to protect your retirement account from the bond market collapse that is unfolding. We also need to cover the psychological shifts you need to make to survive in an inflationary depression. The storm is here and the time for preparation is running out fast for those who are still undecided. You need to decide if you are going to be a creditor to a bankrupt nation or an owner of real assets. That decision will determine your financial destiny for the next decade and beyond. The only way to win a rigged game is to stop playing by the rules that were designed to make you lose. For the last 40 years, the rules of the financial game were simple and they worked for almost everyone. You worked hard and you saved your money in a bank account and you bought a diversified portfolio of stocks and bonds. But in a world of $38 trillion of debt and fiscal dominance, those rules are now a suicide pact. The savers are going to be the victims of the greatest wealth transfer in the history of the United States. To protect yourself, you must shift your identity from being a saver of currency to being an owner of real assets. We need to distinguish between currency, which is the dollar, and money, which is a store of value and energy. The dollar is a political tool that can be printed into infinity by a committee of bureaucrats in Washington, D.C. Real money is an asset that has a finite supply and cannot be diluted by the stroke of a pen or a keyboard. The first asset class that you must understand in this new paradigm is the one that has survived every empire collapse. Gold is not an investment that you buy to get rich. It is insurance that you buy to stay rich. There's a reason why central banks around the world are buying gold at the fastest pace since 1967. They know that the U.S. Treasury market is becoming unstable, and they are moving their reserves into the only neutral asset. Gold has no counterparty risk, which means it is the only financial asset that is not someone else's liability. If you own a bond, you're relying on the government to pay you back with money that has purchasing power. If you own gold, you simply own a piece of physical matter that requires no promise from any government. In a period of financial repression, gold acts as the ultimate hedge against the debasement of the currency. It historically reprices higher to account for the increase in the money supply that the government is creating. But for the digital generation, there's another asset that is serving the exact same function with even more speed. Bitcoin has emerged as the digital gold for a world that is increasingly losing trust in centralized institutions. The mathematics of Bitcoin are the exact opposite of the mathematics of the United States dollar system. There will never be more than 21 million Bitcoin in existence, no matter how much debt the government issues. It is the first asset in human history with a supply schedule that is completely inelastic to price demand. When the price of gold goes up, miners dig more gold out of the ground, which increases the supply. When the price of Bitcoin goes up, the supply issuance does not change because it is governed by code, not humans. This makes it the hardest asset ever discovered and a perfect sponge for soaking up excess liquidity. Wall Street has finally woken up to this reality, which is why you see the largest asset managers filing for ETFs. They realize that in a world of $38 trillion of debt, clients need an asset that cannot be debased. You do not need to be a crypto bro to understand the game theory of owning a non-sovereign bearer asset. It is simply a vote against the fiscal irresponsibility of the government and a vote for mathematical certainty. But not everyone is comfortable with digital assets or precious metals, and that is where real estate comes in. Real estate is unique because it allows you to use the government's inflation policy against them. When you take out a 30-year fixed-rate mortgage, you are essentially shorting the US dollar. You are borrowing money today that has a certain value and paying it back over 3 decades with devalued dollars. The inflation that destroys your grocery budget actually helps you pay off your mortgage debt much faster in real terms. If inflation runs at 5% for a decade, the real value of your debt is cut in half without you doing anything. This is the one cheat code that the middle class has to build wealth in an inflationary environment. But you have to be extremely careful about what kind of real estate you buy in this specific cycle. Commercial real estate is a death trap right now because of the vacancy rates and the refinancing risk we discussed. You want to own residential real estate or productive farmland that has a scarcity value and practical utility. You want to own things that people need to survive, regardless of what the economy or the stock market is doing. This brings us to the death of the traditional 60-40 portfolio of stocks and bonds that advisors love. For 40 years, bonds were the ballast in your portfolio that protected you when stocks went down. But in a world of fiscal dominance, bonds and stocks are now correlated because they both depend on liquidity. If inflation spikes both stocks, and bonds can go down together, which destroys the safe portion of your retirement. You need to replace the bond portion of your portfolio with real assets that thrive in an inflationary world. This includes commodities like oil and copper and energy infrastructure that powers the global economy. These are the inputs to production, and their prices must go up if the government prints more money. The transition from a financialized economy to a real economy is going to be painful for Wall Street, but it creates a massive opportunity for investors who position themselves in tangible assets before the herd arrives. The psychological shift is the hardest part because we have been conditioned to trust the bank. You have been taught that cash is king, and that saving money is the path to financial security. But in a high inflation environment, cash is trash, and savers are guaranteed to lose purchasing power. You have to get comfortable with the volatility of owning real assets rather than the stability of losing money slowly. You also have to think about counterparty risk, which is something most Americans have never considered. When you leave your money in a bank, you are technically lending that money to the bank. You become an unsecured creditor of that institution, and if they fail, you are reliant on the FDIC to bail you out. With the banking system sitting on hundreds of billions in unrealized losses, that is not a risk you should take lightly. Diversifying your custody is just as important as diversifying your asset allocation in this environment. You should have some assets outside of the traditional banking system entirely to protect against systemic failure. This is why self-custody of assets like gold or Bitcoin is becoming a critical part of a modern wealth strategy. It gives you a break glass in case of emergency option that is not dependent on a bank website working. The $38.5 trillion debt is a gravitational black hole that is warping the fabric of the economy. It is forcing everyone to move further out on the risk curve just to maintain their standard of living. But the biggest risk of all is doing nothing and hoping that the politicians will solve the problem for you. Hope is not a strategy, and denial is a luxury that you can no longer afford in 2026. You need to take an audit of your personal balance sheet and ask yourself a very simple question. How much of my wealth is dependent on the solvency of the United States government? If the answer is everything, then you are fully exposed to the debt trap that we have been analyzing. You're standing on the train tracks, and the train is coming and you are refusing to move. The wealthy are already moving. They are buying ranch land and art and gold and private businesses. They are getting out of paper currency and into hard assets that will survive the coming currency reset. You do not need millions of dollars to replicate this strategy. You just need to change your mindset. You can buy silver coins or a fractional Bitcoin or a rental property or shares in a commodity producer. The specific asset matters less than the decision to opt out of the fiat currency devaluation trap. We are entering a period of volatility that will rival the 1970s or the 1930s. There will be winners and there will be losers, and the difference will be financial education. The winners will be the ones who understood the math of the debt and positioned themselves accordingly. The losers will be the ones who trusted the official narrative and watched their life savings evaporate. I am doing this research because I do not want you to be one of the victims of this financial repression. I want you to thrive and build generational wealth while the rest of the world is panicking. The system is broken, but that does not mean that you have to go down with the ship. You have the power to build your own lifeboat and secure your financial future regardless of what the Fed does. The $38.5 trillion number is scary, but it is also the greatest signal you will ever get. It is the signal to take action and to take control of your own financial destiny starting today. Do not let the fear paralyze you, let it motivate you to learn and to execute a plan. The window of opportunity to position yourself is closing as the crisis accelerates day by day. Make the decision right now to become an owner and not a victim of the debt trap. If you found value in this deep dive series, please hit that subscribe button and turn on notifications. I'm going to continue tracking this crisis in real time and bringing you the data that the mainstream media ignores. Share this video with someone you care about who needs to wake up to the reality of the economy. And leave a comment below telling me which hard asset you trust the most to protect your family. Is it gold? Is it Bitcoin? Is it real estate? Let's get a debate going in the comments section right now. I read every single comment, and I want to know how you're preparing for the years ahead. Thank you for watching, for being part of the community that is paying attention to the truth. Stay safe out there, invest wisely, and I will see you in the next video update very soon.